Welcome to our premium Konsults.ai podcast, where we dive deep into SE's latest quarterly results through our rigorous Big Four consulting lens. This quarter, SE has shown some intriguing shifts in financial health and operational performance. We're taking a comprehensive, data-driven approach, looking at revenue trends, EBITDA progression, and cash flow dynamics, all tied back to strategic implications. Our goal today is to unpack these numbers with precision and clarity, setting the stage for actionable insights.
Absolutely, Shekhar. We're applying advanced quarterly process intelligence to detect key inflection points in SE's financial trajectory. Our analysis covers working capital efficiency, specifically DSO, DIO, and DPO trends, margin decompositions, and profitability drivers with a granular view. We'll benchmark SE's performance against peers to highlight where they stand in their competitive landscape. This ensures our listeners get not just the what, but the why and how behind the numbers.
And from a practical perspective, this isn't just about numbers on a page. Understanding SE's quarterly shifts in margins, cash management, and strategic risks is crucial for CFOs and investors alike. It's about connecting financial metrics to real-world decisions, whether that's managing supply chain risks or capitalizing on market opportunities. So, stay tuned as we break down the complexities and provide clear, actionable takeaways for both the boardroom and portfolio management.
Let's begin with a close look at SE's top-line performance this quarter. SE reported revenues of $3.2 billion, marking a 4% increase from the previous quarter and an 8% rise compared to the same quarter last year. This steady growth suggests resilience in their core markets, despite macroeconomic headwinds.
Right, Shekhar. If we dig deeper into the quarterly trajectory, the sequential growth of 4% is supported by strong volume upticks across both domestic and international segments. Year over year, the 8% growth outpaces the industry average, which hovers around 5 to 6% for peers like Company X and Y. This indicates SE is gaining share or benefiting from more robust end market demand.
From a CFO perspective, sustaining a 4% quarter-over-quarter growth in this environment is commendable, especially when supply chain pressures remain volatile. But it's not just about revenue growth. Cash generation and margin stability are equally critical for operational health.
Absolutely, Raj. Moving to profitability, SE posted EBITDA of $780 million this quarter, translating to a margin of 24.4%. This represents a slight improvement from 23.8% last quarter and is up from 23.5% a year ago. The upward margin trend reflects better cost management and some pricing power, despite inflationary pressures on input costs.
Adding to that, the EBITDA margin expansion, though moderate, is significant in the context of rising raw material costs industry-wide. Peers such as Company Z have experienced margin compression this quarter, declining by 50 basis points on average. SE's operational leverage and supply chain optimizations appear to be key differentiators here.
This margin resilience is crucial. It suggests SE is effectively managing costs and possibly passing through price increases to customers without sacrificing demand. The net income margin also holds firm at 14.3%, with net income reported at $460 million, stable compared to prior periods, signaling controlled interest and tax expenses.
Turning to cash flow, SE generated $600 million in operating cash flow this quarter, with free cash flow at $450 million after capital expenditures. This robust cash conversion ratio underscores strong working capital management and CapEx discipline, which we'll explore further in upcoming segments.
Indeed, when benchmarked against peers, SE's free cash flow margin stands at approximately 14%, higher than the peer group median of 11%. This highlights superior liquidity generation and flexibility to fund growth initiatives or shareholder returns, a critical competitive advantage in today's environment.
From a strategic standpoint, these cash flow metrics provide a solid foundation for either reinvestment into innovation or M&A, while maintaining a healthy balance sheet. SE's ability to generate consistent cash flow amid margin pressure is something CFOs and investors should note carefully.
In summary, SE's quarterly trajectory reflects steady revenue growth, margin expansion against peers, and strong cash flow generation. These factors combined suggest that SE is not only navigating current challenges well, but is also positioned to capitalize on emerging opportunities. We'll delve next into the specific inflection points driving this performance.
Looking closely at SE's quarterly financials, we observe several key inflection points signaling a regime shift. Notably, the sequential revenue growth accelerated from 2.5% last quarter to 4% this quarter, suggesting a positive change in demand dynamics. Meanwhile, EBITDA margin improved by 60 basis points, marking a break from the prior trend of marginal contraction. This signals operational leverage kicking in, likely due to improved cost controls and pricing initiatives.
That's a critical insight, Priya. From a strategic standpoint, these regime changes hint at SE's ability to adapt to inflationary pressures while maintaining growth momentum. This could be a structural shift in their business model, moving from volume-driven growth to a more margin-accretive model. It's important to note how these financial inflection points align with management's recent emphasis on supply chain optimization and selective pricing.
Absolutely, Shekhar. From a CFO perspective, the uptick in margin amid a challenging macroeconomic backdrop often reflects disciplined expense management and better working capital practices. But what catches my eye is the change in capital structure this quarter. SE reduced net debt by 5% sequentially, which is a material move compared to flat debt levels in prior quarters. This suggests an intentional shift towards deleveraging, improving financial flexibility.
Good point, Raj. Diving deeper, we also see a notable contraction in DSO by 3 days, reflecting tighter receivables management, which supports cash flow quality. However, there's an atypical jump in inventory days by 5 days this quarter, possibly linked to strategic stockpiling amid supply chain uncertainties. This increase, while raising working capital temporarily, could position SE better for upcoming demand surges.
That inventory build definitely represents a tactical regime shift in operational execution. It signals that SE is anticipating volatility and choosing to preempt supply constraints. Strategically, this moves them from a just-in-time inventory model to a more resilient, buffer stock approach. While it impacts short-term liquidity, it strengthens the overall supply chain reliability, which is vital for sustaining growth and margins in uncertain markets.
Exactly, Shekhar. This kind of regime change in working capital strategy, trading some cash flexibility for supply assurance, is a nuanced CFO decision. It's a risk-balancing act. If managed well, it can create competitive advantage. But if inventory levels aren't drawn down timely, it could strain free cash flow. Investors should watch closely how SE manages this inventory over the next few quarters to assess whether this is a durable shift or a short-term reaction.
Let's start by examining SE's key working capital metrics this quarter. Days sales outstanding decreased by 3 days to 42, indicating tighter receivables management. Conversely, days inventory outstanding rose by 5 days to 60, which aligns with SE's strategic stockpiling amid supply chain volatility. Days payable outstanding remained relatively stable at 38 days.
From a CFO standpoint, that DSO improvement is a positive sign. It accelerates cash inflows and enhances liquidity. But the inventory build is a double-edged sword. While it buffers supply disruptions, it ties up cash and can pressure free cash flow if those inventories aren't converted quickly.
Exactly, Raj. The increase in DIO signals a deliberate shift from just-in-time towards a more resilient supply chain model. It's a tactical decision to mitigate supply risks, but does temporarily elevate working capital needs. The fact that DPO stayed flat means SE isn't extending payables to offset this build, so the cash conversion cycle has modestly lengthened this quarter.
Benchmarking these figures, SE's DSO at 42 days is better than the peer median of 47, reflecting disciplined receivables control. However, Their DIO at 60 days is now above the peer average of 52 days, confirming this inventory buildup is a deviation from industry norms and likely a short-term response to market uncertainty.
Right. And this raises an important CFO trade-off, sacrificing some short-term liquidity for operational stability. If SE manages to draw down inventory in the next quarters as supply normalizes, this should pay off by reducing stockouts and protecting margins. But if inventory lingers, it risks cash flow compression and potential write-downs.
In summary, SE's working capital dynamics reveal a careful balancing act, improving receivables and maintaining payables discipline, while accepting inventory inflation to safeguard supply continuity. For investors, this signals operational prudence, but also highlights a watch point on inventory management execution in the coming quarters. Let's dive into SE's margin profile this quarter, starting with the gross margin, which clocked in at 39.2%. This is a 70 basis point improvement from last quarter's 38.5%, signaling effective cost controls amid inflationary headwinds.
Yes, Shekhar. The gross margin expansion is noteworthy given the 8% year-over-year revenue growth, especially when input costs like raw materials and logistics have increased approximately 5% industry-wide. SE's ability to offset these pressures points to strong pricing power and supplier negotiations.
From a CFO lens, improving gross margins while facing rising input costs isn't trivial. It suggests SE has successfully implemented selective price increases without denting volume. This kind of pricing discipline, combined with operational efficiencies, usually reflects robust commercial execution.
Moving down the income statement, SE's operating margin increased to 18.1% this quarter, from 17.5% last quarter and 17.2% a year ago. This 60 basis point rise indicates more than just cost containment. It reflects operational leverage as fixed costs are spread over higher volumes.
Absolutely, Shekhar. On the cost structure side, SG&A expenses were contained at 12% of revenue, slightly down from 12.3% last quarter, despite increased investments in technology and supply chain resilience. This balance shows disciplined expense management paired with strategic spending.
I'd highlight that SG&A discipline, alongside targeted CapEx, is a hallmark of smart management. They're not cutting costs indiscriminately, but optimizing spend to support growth areas while safeguarding margins.
Net margin held steady at 14.3%, supported by controlled interest expenses and a stable tax rate of 21%. The margin stability here signals SE's prudent financial management, ensuring that operational gains translate down to the bottom line.
Linking these margin trends to profitability drivers, we see three key factors. First, pricing power that offsets inflation. Second, enhanced operational leverage from volume growth. And third, supply chain efficiencies reducing variable costs. Together, these underpin margin resilience.
One risk I'd flag is the sustainability of pricing power if competitive dynamics intensify. But if SE continues to innovate and deepen customer relationships, it could maintain or even expand these margins.
In conclusion, SE's margin expansion this quarter is a strategic win. It demonstrates that their pricing initiatives, cost discipline, and operational improvements are effectively aligned. For investors and management alike, this margin momentum offers a clear signal of durable profitability enhancement.
Let's start by addressing the strategic risks facing SE in the current landscape. Market volatility remains a persistent threat. Macroeconomic uncertainty, fluctuating commodity prices, and potential supply chain disruptions could all pressure margins and growth. On the regulatory front, evolving trade policies and stricter environmental standards pose compliance costs and operational risks that SE must anticipate.
Building on that, from a data perspective, we've seen early indicators of tightening regulations in key markets where SE operates, particularly around emissions and digital data governance. These could increase operating expenses by 2 to 3% over the next 12 months if not proactively managed. Additionally, geopolitical tensions suggest potential tariffs or export restrictions, which could disrupt SE's global sourcing and sales footprint.
Strategically, these risks highlight the importance of agility in SE's business model. The company's recent shift to buffer inventory and deleveraging suggests a defensive posture. However, beyond defense, SE needs to integrate regulatory foresight into its planning and accelerate digital transformation to mitigate disruption. This means embedding compliance capabilities and flexible supply chain architectures into core operations to maintain resilience and competitiveness.
Turning to opportunities, innovation remains a key lever for growth. SE's investments in R&D and supply chain digitization position it well to capitalize on market expansion, especially in emerging economies. However, on M&A, I'd caution investors and management. While acquisitions can accelerate scale and capabilities, integration risks and inflated valuations in this environment mean SE must be selective and disciplined to avoid value erosion.
Agreed, Raj. Technological disruption is both a risk and an opportunity. SE's adoption of AI-driven analytics and automation can enhance operational efficiency and customer insights, potentially lifting margins further. Yet rapid tech shifts also require ongoing investment and talent management. Falling behind in digital capabilities could erode SE's competitive edge, particularly versus more agile, tech-native peers.
To conclude, SE's strategic risks, from market volatility to regulatory and technological challenges, require a proactive, integrated approach. Opportunities in innovation and expansion are tangible, but hinge on disciplined execution and risk mitigation. For investors and executives alike, the takeaway is clear. Balancing growth ambition with prudent risk management will be critical for SE to sustain its trajectory and build durable competitive advantage. Let's turn to SE's industry positioning. This quarter, SE maintained a market share of approximately 12.5% in its core segments, a slight increase from 12.1% last year. This gain is notable given the intensifying competition and slower overall market growth, which is hovering around 3%. SE's focus on both domestic and emerging international markets appears to be paying off, allowing it to outpace peers like Company X and Y, which have seen flat or declining shares.
Building on that, when we benchmark SE's revenue growth and margin trajectory against top competitors, SE is outperforming in several key areas. For instance, SE's 8% year-over-year revenue growth contrasts with the 5% average among its top 5 peers. Moreover, SE's EBITDA margin at 24.4% exceeds the peer median of 22%, reflecting stronger operational efficiency. Interestingly, peers such as Company Z have recently faced margin pressures due to higher input costs and less agile supply chains, which SE seems to be managing better.
From a practical standpoint, SE's ability to combine growth with margin expansion is a big deal. Many competitors are stuck in trade-offs between volume and profitability. But SE's strategic investments in supply chain resilience and selective pricing are allowing it to thread that needle. The question is whether this edge is sustainable, especially as peers ramp up their digital transformations and cost optimization programs. SE must keep investing to avoid being leapfrogged.
Good point, Raj. Strategically, SE's move towards a more diversified geographic footprint and deeper penetration into high-growth emerging markets is a distinct advantage. It offsets slower growth in saturated markets and provides a platform for innovation adoption. However, this expansion also brings exposure to regulatory complexity and geopolitical risks that some peers are less burdened by, which SE must actively manage.
Exactly, Shekhar. On competitive dynamics, we're also seeing peers accelerating partnerships and M&A activity to consolidate capabilities, especially in technology and supply chain digitization. SE has been comparatively cautious on the M&A front this quarter, focusing instead on organic growth and operational improvements. While this reduces integration risk, it could limit speed to market against more aggressive rivals, if market consolidation continues.
To wrap this up, SE's current industry position is robust with clear competitive strengths, market share gains, margin leadership, and operational discipline. Yet, the evolving competitive landscape demands vigilance. SE's leadership must balance the benefits of its prudent strategy with a readiness to pivot, whether through selective acquisitions or accelerated innovation investments, to defend and extend its advantage over the medium term.
To wrap up, SE's latest quarter underscores a resilient financial trajectory marked by 8% year-over-year revenue growth, expanding EBITDA margins to 24.4%, and robust cash flow generation with a free cash flow margin of 14%. Their deliberate shift toward inventory buffering and working capital discipline reflects a strategic pivot designed to safeguard supply chain resilience amid volatility. These moves, paired with prudent deleveraging, position SE well for sustainable growth and margin expansion, but require vigilant execution going forward.
I agree, Shekhar. From the CFO vantage point, the key watch area remains the elevated inventory levels. If SE manages to draw down this stock effectively without disrupting operations, it will convert this tactical decision into a competitive advantage. The strong cash flow profile and margin discipline provide a solid runway for selective investments, but management must remain disciplined around capital allocation, especially on the M&A front, where integration risks are real in today's environment.
Adding the final perspective, SE's superior revenue and margin performance relative to peers highlights their effective commercial and operational strategies. However, the evolving regulatory and technological landscape requires ongoing adaptation. Their investments in AI and supply chain digitization are critical to maintaining this edge. Ultimately, disciplined execution on these fronts will determine if SE can not only sustain, but also extend its market leadership in an increasingly competitive and complex industry environment.